see a little bit about me. Thank Stan for his gracious comments. McMillan Analysis and Larry's book in the very beginning when I started clerking back in the late 70s obviously was the go-to book to give you all the inside knowledge of learning what to do with options and trading. And through my career, as you can see, it's spelled out up there. I've done almost everything, include helping build the hybrid system on the CBOE during my days there. And then I actually left the CBO and trading for a stint of 2006 to 2015 to be able to help with the development of single stock futures, which was owned by the major exchanges and then eventually owned by Interactive Brokers in consortium with them as well. And then after that, I ended my term there in 2015, and I didn't stop. I went on to help manage my best friend Ralph Katz's biotech fund with him from 16 to 22. And then at the end of 22 is when I started deciding to do things from home besides trading. And I was told by a couple of folks at the CBO Options Institute that McMillan Analysis was looking for a mentor. And since I thoroughly love teaching and mentoring, so I went and gave a call to Stan and Larry. And subsequent to that time, I joined them. I think it's almost about 2.5 years now I've been doing mentoring for them, which has been very enjoyable. So we wanted to put together some, first of maybe a few free webinars to hopefully introduce what we do and how we do it. I'm very proud of everything that we do at McMillan Analysis. There's enormous subscriptions that are very valuable. Our mentoring program, I would be willing to challenge any mentoring program in the world at how we teach and help people understand options, because there's such a vast wealth of experience in the option space. And myself, being in the pit for 30 years plus and continuing on, I've seen it all. And this past 3 weeks, I'm just adding another notch on my gun of all those events that I've been participating in, what's happening with the market in this day and age. I was there for the crash of '87, which wasn't very pleasant for me, but I worked my way through it. I was there with the tech crash. I was there for September 11th, of course, unfortunately, a very sad day for our country. And I've been continuing on there. In 1999 through 2004, I helped Wolverine Trading attain a designated post-market making group and worked with them as partners. And then I left for One Chicago, trying to work out the single stock futures. So I wanted to come up with what I thought would be a great, simple strategy, which is part of our mentoring program. In our mentoring program, we have a combination of bonus materials that you get when you sign up, which is the first book that Larry put out there, which is an A to Z of everything you want to know about options, a 14-hour home study course from the beginning to end, early stage, middle stage, end stage. We've got subscription letters that are tremendous, and to this day, I think Larry's weekly newsletter that goes out, Options as a Strategic Investment, is one of the best letters on the street, because I think Larry is one of the foremost prognosticators of the market, as he always has been, and I thoroughly enjoy that. So there's a lot of very valuable information besides just having the one-on-one mentoring, which I think is a very attractive proposition for people that want to learn how to understand options, understand how to trade. When you look at Wikipedia and you go out there and you Google different sites to help teach you, it's rather interesting. I enjoy it. It provides levity for me because, to really understand the option world and how options work. It's more than just reading about it. It's more than just watching a video. It's being able to see it, and how I basically teach and do mentoring for McMillan, and that's in a practical application of using live markets and pointing and talking about live markets, which is very important because one of my main emphasis initially is to teach the students to understand the market environment. If you understand that, it's a leg up. And I have an outline, and in that outline, we go from the bottom up, building a core, dealing with synthetics, dealing with call put parity, and then from there, we work our way to understanding volatility, how important standard deviations are. And of course, if anybody knows anything about volatility, that's where the Greeks lie in the pricing, the 6 pricing elements of options. Everything is defined in those 6 elements. The only variable, obviously, is the predicted volatility, which is implied, historical, which every day we have yesterday and before, and then predicted is how everything is skewed going forward. These are the keys to becoming a very knowledgeable options expert of what you're doing. And then from there, we take that to what I call my trading strategies, which is an outline of probably a good 15 concepts of trading. And they go anywhere from strategies that can be used to be neutral, long and short, strategies for selling premium, strategies for buying premium. So we cover the whole gambit of different types of strategies, how they work. And in my mentoring sessions, what I do is basically help students build a playbook for every strategy, and we basically create criteria for those playbooks. And along with that, obviously, by dealing in the live markets every day, the 0 days to expiration option, which I'm sure most of you are cognizant of, is a tremendous tool for understanding the Greeks. And the Greeks is probably the major focus in what we do. Why? Because that's the piece of the puzzle that destroys and causes pain to most retail traders, because they really don't have a handle on those Greeks, which is why statistically, why those folks that trade futures and options that are retail without the knowledge that they need to be equipped with to be successful, they normally go through their capital in the first 90 days of existence, and that's 90% of them. My goal with the mentoring program, with the tools that are given by McMillan and the tools that I use from my experience, basically, we're trying to make the proposition of what anybody that doesn't know anything of the market, if you ask them, is the market going up or down, they start at a 50-50 probability of being right. Well, the goal at McMillan is to move that from 50-50 to 85% in your favor. And if you have that acumen of knowledge and spreads and understand the Greeks, and also I deal a lot with making sure that individuals understand the philosophy of trading, the disciplines of trading, what's the most important part of trading, which a lot of people don't understand, is we like to take and cut our losses small and let our profits run. So today we're going to talk about the butterfly, which has always been one of my favorite option strategies. And the reason why is how I came to suggesting it. When we talk about, there's our disclaimer slide, which you'll see in the PowerPoint, which will be saved and recorded for you to have access to tomorrow. And this is what we will be presenting today. We are talking about the butterfly strategy. And what I was able to create, which is quite interesting, it became very fortunate. I started creating this butterfly strategy on the 14th of March, and every one of the slides that I have in the presentation happened to work out perfectly for exactly what I'm trying to describe. I'm not one that likes theoretical. I'm not one that likes creating your own slides with stock XYZ. I like to use real stocks, real markets, and I thank Schwab and their Thinkorswim platform for the use of the technology which I have to create charts for my explanations. So I want everybody to realize that you can see there, we're going to cover the butterfly as an overview, neutral, bullish, bearish. And when you do a butterfly, you could do butterfly strategies in calls and puts and individual stocks and indexes. What is the butterfly? In the second paragraph there, you see I explain it. It combines two vertical spreads, always in the same expiry, either call or put, as I have said formally, with strikes consecutive and the difference between the strikes equal. In other words, as an example, the butterfly for a 321 expiry, which has passed, the 115, 120, 125, a 5-point call butterfly. You could do a 110, 120 to 130. You could do much larger ranges. And if you become an expert at butterflies, there's also another strategy called broken wing butterfly that we're not going to talk about today. But that's when the verticals are not equal to each other. So let's move on. And what I've done here is I've created the three forms of the butterflies. I'm showing a neutral butterfly, which basically would be with the stock 120 for an expiration, for a trade date of 314 with the expected expiry of 321, a week forward from that. I'm looking for the stock to close on that expiry right at the middle part of the butterfly. So in other words, when you look at the butterfly, we've got the 115 to the 120, 125 butterfly on. We want the stock to close at 120. And the purpose of that is the long vertical, because we're buying it, which I'll explain and show you, is going to be worth its full value of 5, the difference of strikes, 115 to 120. And the short vertical, the other side of the butterfly, is going to be worth 0. Therefore, the butterfly would reach its maximum value of 5, and you would stand the profit of whatever you paid for that against the 5. The second view is going to be that of a bullish perspective. And this is important because this is what I love about butterflies. You can take any of these stances in determining what strategy you're looking for as far as movement of a stock or index. In a bullish view, you're expecting the stock to go up. So what do? I change the strikes to try and have the midpoint be higher than the previous of a neutral strategy. We'll show slides and talk about that. And the bearish view would be the opposite. And because we're doing a bearish view, I like to use the puts because there are smaller notional value contracts. And the goal there is for the stock to decline to hit my middle strike for the put butterfly. So we're going to move on. And let's get to slide 3. Okay, so the slides that I'm going to be showing, which are charts, are going to be slides 7 through 12. And that's going to represent the depiction of an actual butterfly that was created on 3/14 for the following Friday's expiry. The butterfly was the 115, 120, 125, which is a 5-point butterfly. Okay, I'm using a 5-point differential of the strikes, 5 points. It expires on the 21st. And we're going to look at the value at the closing of the trade date of each of the days from 3/14 through the Friday expiry of the 21st. The price that we're putting this on for, as I described, is you buy one call, 115, expiry 3/21. You sell 2 calls, the 120, and you buy 1 call, the 125. All of the 3/21 expiry, okay? You're buying 1, you're selling 2, you're buying 1. When you do that, we have the same expiries, we have a 5-point differential in strikes, and if you think that through, and you'll see it, we have the 115.20 vertical on, that's the 1 by 1, and then we're short the 120, 125, i.e. the reason why you sell 2 of the middle strike. The goal is to hit the target right in the middle at 120. The beauty part about that is it doesn't have to be 120 at the expiry for you to make money. And I will talk and explain that. So that's the beauty of a butterfly. it gives you a range of expectation for opportunity to make a profit. And the other part about it that I like about butterflies when you buy them, and I could explain selling one as well, but when you buy a butterfly, that's your cost. That's your risk. In our example, and I'm going to pull up slide 7, you're going to see the cost that we put it on at was 86 cents. So I'm paying 86 cents for a 5-point butterfly that I'm hoping I can get the stock, which I don't have anything to do with it, but hopefully the stock closes at 120 on 321. Profit potential, I paid 86. 5-point differential in strikes. Max of that vertical that I'm long is 5 on the long side. The short side would also be 5. But my goal is for the stock to hit 20 at expiration and just stop. If it did that, I paid 86 cents for it. 5 points minus 86. My profit potential would be 414. Factors to achieve profitability. Our stock price, of course, working in our direction and favorable, and time. More importantly, time. Time, you will understand, not as much in this presentation because it's really a great presentation to really understand. It's understanding in 0 days to expiration, where I put on a lot of strategies relative to maybe premium selling strategies like iron condors, iron flies, or butterflies, or other types of strats where you might be buying verticals, selling verticals, a myriad of them, which are available in all of our mentoring possible segments that we do. Time is the most important part of the Greeks. Why? The more time, which you're going to see in my butterfly presentation, the more probability and possibility of change of price and change of the option prices. The less time, now those factors in time are shrinking, there's less probability. I'm sure most of you understand probability. Well, when you're talking about probability of time, the more probability, the less time, the less probability. So if we can get in the video, which is my example, close to 120 for the 321 expiry, I'm going to start feeling pretty good. Let's go to the next slide. There it is. This is what this graph looks of. If you look at the very bottom, it's for the expiry of March 21st. And if you look at the trade date, which is right in the middle, hopefully you can see. Let me see if I can put my pointer. Yes. Okay. We're looking at the bottom of the chart, 115, 120, 125 call. You can see I'm buying 10, I'm selling 20, buying 10, which is a multiple of 1 by 2 by 1, 10 times, obviously. It's a call, so I'm buying the lower strike at the 15. I'm selling 2 of the middle at 120, buying the 125. And as you can see, I'm paying 86 cents for it. The other important piece of the puzzle that's really significant is when you look at the Greeks / the implied volatility, notice that if you add up the long and the short fall right here, 93 and 79, which is the outside wings of the butterfly, the 15s and 25s, you've got 172 total vol. When you sell your 2 vol in the middle, what's your total vol? 86 times 2, 172. So the butterfly is very volatility / Greek agnostic is how I view that. So vol up, vol down, you're not going to have that fear of what happens to me of premium decay. Well, it's all nice little, sweet little package of 3 options that are all working to your advantage. What's the advantage? There's the goal, the very top. The pinnacle of this trade is right here about 120. The price that day, 120 and 3/8, very close to it. Okay, but why is it 86 cents, you say? We still got 7 days, don't we? Yes, we do. 7 days means more time, means more probability and possibility of the stock moving. So pay attention to that. And our break-evens are going to be on the left side with the red dashes. And obviously the break-evens are 115.86 and 124.14. As you can see, that's where they line up. All right, so this is our trade that we created on the first day, the end of the day on March 14th, that Friday. So now we're going to go into the next slides and showing what is the time cycle that's occurring here. Next day, which is on Monday, 3/17, butterfly is now priced at 110. Stock is 119.82. Same profile, technically, from the way it's viewing, looks like a teepee. Okay, there's your break even. And when you look at the purple line here, well, that's premium decay of what you paid for your $86 cents at the time. Now it's 110 times 10. So that looks like $1,000. It is. If the stock moves way away from your midpoint or out of range of your break even, you start to lose money, but you still have a range, if you look at it, of 115.14 to 124.14, 9-point range. Nice range to try and capture a profit. Let's move up into our next slide. All right, here we are in day 3, Tuesday, the 18th. The butterfly stock is 115.08. Time is decaying, meaning that probability is reducing for the butterfly to have the potential to be inside of our range. What's our perfect range? 120. Where is it at? 115.08. What's our butterfly? It actually went up in price to $1.24. Okay, why? Less time. It's in a probability range of getting near that 120 price, which is right up there on top, even though the stock is lower priced. That's why the chart's showing you that, we might be in harm's way where the purple line, if we continue to go down, we're going to lose money that we put forth on this trade, which is basically, 10 times the market value right now, which is $1.24. But remember, our true cost is 10 times the 86 cents, or $860 in this particular case. Let's move on to slide number 10. Okay. Here we are on the 19th, which is that Wednesday. The stock is now 117.96. Our 20 area obviously is still the top of the teepee. That's where we make our most money at expiry. But now the stock is basically moving up from that 115 price to 117. It's moving towards that pinnacle top price of 120. So look at the price of the butterfly now. It's $1.78. 86 to the next level to 178. What's the max it could be worth? It could be worth $5. But here we are on Wednesday, it's worth $1.78. We paid 86. We just doubled our money, didn't I? If we want to get out, we could take the profit here at 178, make that 82 cents, and we're on our way. 178, 86, 92 cents. You can take it off. So what I always explain to a lot of the students and a lot of the people that I teach is when you do butterflies, you want to make sure that you do a 2 lot as a minimum. Why? Because you're going to see how opportunity offers itself to take a profit where basically if I take one off, I might be able to get the other one for free. Okay? And when you think about that, 860 and 860, okay, $1,720. I sell one at $1.78. I just covered that and I got a freebie. Let the runner run. Let's go to the next slide. Now we're entering in a very important factor of the Greeks. The Greeks wake up, get very, very, very real on the Thursday before Friday expiration. Here we are, stock on Thursday. Stock price, 118.53. Look at the fly. Its price, 260. Right here, 260. There's our break-evens. They're not changing much. But we got to look at the example of where we're at. Look how the TP still 120, baby. That's where we make the money. But now we are entering into a real sweet spot. Well, according to me, we're already at that sweet spot, 260. I paid 86 cents for this thing. So would I like to take $1.74 off the table? Why not? I got it on 10 times. I'm not greedy. I'm going to take off probably 5, at least 5, maybe 7. Nice profit. Nice profit. It still has an opportunity to get to the peak of 120 on that following day because we're not that far away. But remember, stocks move, as you can witness by the last 3 days of this week. And, you know, probability opens the door for anything to happen. But what has happened with probability? Probability has been minimized because time is shrinking. Time is shrinking, and the butterflies starting to come to the point where I like to call it the wings start to come out. And the baby's going to start flying because it's got a shot to hit the top of the mountain at 120. My favorite part of butterflies. You're very fortunate if you hit the middle strike. But I don't care that much about the middle strike. Once I'm in range and I've got profitability and I can now manage my risk by taking a chunk of it off, locking up a great profit, and leave 2 or 3 to see if I can climb that top mountain at 120. So we take this to the next day, the final day, expiration Friday, which is the last slide. And when you look at that, stock is now lower, 117.86, and that's where it closed. So when you think about that, that debit price is not accurate. Why? Because at 117.86 on expiration Friday, the butterfly is really worth the price of the low, the 15, versus the price of the stock. Stock minus strike is 286. That vertical is worth 286. And that's the price, basically, of the butterfly, 286. You paid 86 cents. The remaining amounts that you have are making $2 a piece because the butterfly at that point is going to only have on the long call spread is in the money. So you've got to capture and sell out of your long call spread to realize the rest of your profit. Otherwise, you'll just be exercising the call to stock, and you want to get out of your butterfly prior to any of that so that you relieve all of anything that needs to be done with exercises and you take your profit off the table. So this depiction was a butterfly that was created on the 14th for the 21st. You watch how as time passed, very important, and what happens in time is that the verticals, they start to go to their true values. The call vertical that you're long and the call vertical you're short. And what most people don't understand, and it's very important to understand about verticals and the Greeks, is to every call spread, there's a mirror reflection of that on the other side called the put spread. So our 115, 120 call spread, as the stock was moving out to 120 and time was dissipating, was gaining as much intrinsic value as possible because that put spread mirroring it was losing its value. So it's kind of like as time goes by, you have a situation where the vertical gains most of it, it's extrinsic, and then right at the bell on that Friday, it's all in the money, intrinsic. It's all intrinsic, it's gaining, not extrinsic. There's no more extrinsic, it's only intrinsic. It basically looks just like the 115 call would look. It was parity to the stock from the strike. The other vertical's zero. The short 120s are worthless. And basically, we've got our profitability. And the reason why time is so important is that this left side is the call side of the markets you look at every day. Right side is the put side of the market you look every day. And the left side vertical of the 115.20 has a right side put vertical of the 115.20. And the exchange of intrinsic, extrinsic, as the stock moves close to the expiry Friday towards the strike, the in the money vertical gains as much intrinsic value in the money value, while the put disintegrates to its value that remains. So when you look at this price of 117.86, the call spread is $2.86, right? The same mirror of that 15.20 put spread, guess what? If the call spread is 286, the put spread has to be 214. That's called the box, the call spread and the put spread. And that's where the flows of extrinsic and intrinsic values happen on Thursday and Friday when the probability of movement in time is disintegrating with every hour, especially on the last day of the expiry, which is what happens in 0 days to expiration, which is a tremendous tool that I use for teaching the Greeks. So this was a real live example of a butterfly created for a neutrality range on the 14th all the way through the following week. So what am I talking about going forward? Well, I showed on slide number 14 is a representation of establishing a bullish butterfly, and then again on the 14th for the 21st, okay, if I thought the stock was going to go higher than the butterfly that I created for neutral. So instead of those neutral strikes, I used 125, 130, 135. We bought the one call vertical. We bought the 25, sold the 30. We sold the 30, 35 call vertical, sold 130, bought 135. And what are we looking for? Well, we're looking for NVIDIA to make a bullish move to the 130 area. If I did that trade on that Friday, which I'll show you, on the 14th, I would have paid 78 cents for that trade. Potential, if it goes to 130, 422. Risk, very important. Risk reward is outstanding in butterflies. 78 cents. Factors, the same that we discussed in the neutral side. Why is it so cheap? It's so cheap because there's time left to it. And there's probability of movement of the stock. So let's take a look at that next slide. So on the 14th, when I look at creating this trade with the calls, 25, 30, 35, that would have cost me 78 cents. If you recall, on that same day when the stock was down at that lower price, for the lower strike that we did, I paid 86 cents. Okay? That's what it would look like. We would need the stock to be on the 21st right here. Where's that at? Well, the top of the TP is 130. So that would have been a way to create a bullish view. So I could think if I want the stock to go up in the week, I'll do this one. Okay? Next slide. There's another view, which is going to be relative to, I think the stock's going down. Same 14th trade date for the 21st expiry. And I want to buy the 105, 110, 115 put vertical. I use puts because they're low on notional value, easier to trade. But I'm looking for 110 to be the price instead of 130 in the bullish view and 120 in the neutral view. What do I pay for this, baby? 48 cents. 48 cents. Well, what's my risk reward? You can see there, profit potential of 452. Where is that achieved at? On 321 at 110. I pay 48. I could make 452. Let's look at that slide. Okay, this is what that slide would look like on that Friday the 14th when I'm creating this strategy. And the fun part about that is, well, if I'm bullish, I only have to pay 48, bearish, I only have to pay 48 cents for that play. Times 10 is 480 bucks, of course. But now I'm playing to the downside. So I've given you three depictions. One where you think the stocks for the next week is going to stand still and be neutral. One where you like to take the bullish view because you think it's going higher. Most people think NVIDIA is going higher anyway, other than the last 3 weeks. And the bearish view, where with the stock you think might be going down. And you look at those TPs, the points, those middle strikes is where you're trying to get to. So it's a beautiful, beautiful strategy for depicting a prognostication of where you think a stock is going. And you can see you're not putting a lot of money on the table. And if you get to move in your range, remember, it's a 10-point range. The middle is the sweet spot, the target, but you could have a butterfly like we showed you in the neutral view. It closed out at $2.86. Okay, that was like a little bit more than the middle of where I was going to make money at $5. But guess what? I paid 86 cents. I still made $2 on the remaining 4 or 5 or 3 or 2. And I crushed it on the other ones I let go. So you don't have to hit the middle. What does that tell you? Well, if you're in big price stocks, you can build wide range butterflies. Obviously, the more difference between the strikes, the more the butterfly is going to cost. Well, as a little barometer to help you with that, 5 points, you see what we're paying. 10 points times 2, 15 points times 3, you're going to be very close to those prices. But then when you take the differences of those strikes minus that value you're paying for it, there's quite an abundance of risk reward there. So very, very cool strategy for picking bullish or bearish views in stocks, indexes, SPYs, Russells, QQQ. You could do this in any stock. And basically, this is a very, very prudent and cheap way to try and put on strategies where you're not tying up a lot of capital and you're trying to get inside of your areas of range. So the next 3 charts, what are these? Well, we showed a weekly chart of 3 strategies. So now I'm going to show you if you want to go out in time. And what you're going to find out in time, think about what I said earlier. 1 week probability, there is possibility of a lot of movement until the last 2 days of the expiry. Now, what if you go out with more time? Let's talk about that. Next 3 charts are going to be depicting and representing a neutral, bullish, and bearish view again of NVIDIA, created on 3/14, stock range 115 to 125, expiration 5/16, okay? And that's going to be the expiration for the close of all 3. So you can see right here, this is a view of the neutral view. 115, 120, 125, just like we did on the 14th of March, where that fly went to 286 on the 21st of March. Look at our cost, 35 cents. Wow, you paid 86 for basically the same thing in the same time frame, except now you're going further out to May. Well, profit potential of 35, 465, but now we have to wait for May 16th expiry for things to really happen. What's happened? More time, more probability. Probability goes both ways, for you or against you, but more time. So, why is that important? Because maybe you're bullish or bearish 60 days hence, 90 days hence, 120 days. You can build strategies way out of the money, both call side or put side, because you think a stock's going there. And when you put that on, you don't have to worry about volatility going up or down because you're vol agnostic because of the 3 legs. All you're looking for is a range of where you think the stock is going and making sure that your butterfly width of strikes is encompassing your range. So let's look at this slide for the 26th for a neutral play. If you notice, the timelines are a little different. Still doing a 10 lot by 20 lot by 10 lot, but now we're doing it on the 14th, that Friday of March, but we're going all the way out to May. More time. It's going to have a cleaner look. Why? Because the purple line here, guess what? I'm only risking 35 cents when I put it on. Okay? For the 115, 120, 125 neutral strategy. Why? Well, the stock's trading 120 and 150. What are the chances of it closing at 120 with all that time? Who knows? More time, more probability. It can happen, but maybe not. So what's happening is those mirror reflections of those calls and those put verticals of the same strike differential and expiration, they're playing against each other. Why? The aggregate of the 2 of them has to be equal to the difference of the strikes, which is the box. Another valuable tool in understanding options. Well, 35 cents. Wow. I could buy the 15, 20, 25 NVIDIA out to May for 35 cents. I kind of like that. Well, it all depends on where do you think the stock's going. You think it's going to stay here, go up, come down? It's obviously important to have a good feel for your analysis of the stock. But 35 cents is your risk? Okay, I like that. Next slide. Let's talk about the bullish view. I like these a lot, especially in a bullish market. Bearish market, I like the puts that are under the market. What do you do here? Let's go step it up. Let's look for the 130.35 butterfly, 30 being our center. Our cost, 45 cents. 45 we're risking to make 455. All right, I could deal with that. Same term, 5/16 May, same days to expiration is a lot. We're doing it on March 14th. Okay, we're going way out in time to May 16th, 2 months. We're looking for 130 because why? I think NVIDIA is going to go from 121. It's going to do a nice gradual increase to 130, and my 45 cents is going to turn into something very profitable. Let's look at our volatility. You might say, well, what about volatility? Isn't it all messed up because you got more time? Let's take a look at our May volatility. The longs are 50% and 48.9%, which if you add them together is 98.9. And guess what? The two shorts that you sell is 49 and 49.21, which is 98.42. Once again, pretty vol neutral to me. What am I paying for that view? 45 cents for the view to go to the upside. I like that. I like that as being a very cheap way without a lot of risk for a bullish view. I could buy calls naked. I could sell puts naked. I could buy stock naked. But then do the risk assessment of what you just did there and compare that to a 45-cent butterfly for 5 points. Yeah, you could probably make more money from 121 to 130 on 1,000 shares of stock, but you got risk. That's a lot of risk with 1,000 shares of stock. I could buy exponential times the butterfly for my $450 if I want to spend that kind of money. So you got to look at your risk reward. Option trading is about risk reward. And here I'm showing you examples of what I think are very prudent risk reward. All right, so that's the bullish. Let's go to the next slide. What's that slide going to talk to us about? Well, bearish. I think NVIDIA is going down. I don't like the way the market's acting. It's acting kind of squeamish. I want to play for the downside. I looked on the chart. I like 110 as an area. And it's kind of funky because guess where NVIDIA is right now? 107. And when you think about that, okay, I'll do that. Look at the price of this put butterfly, 20 cents. 20 cents to make 480? Can't be. Something's wrong. Let's look at the slide. Okay. There it is. That's a beautiful looking slide as long as the stock goes down. It goes down, man, are we going to crush it. Look at your P&L up here, up top. It's significant, extremely significant. And, you know, it's very valuable to understanding that because that's what your goal is. Here's our debit. It's 20 cents. Okay. Here's our vols. Once again, if we add up our vols, it's kind of interesting. 52 plus 48 is 100. 50 times 2 is 100. All agnostic. We don't have to worry about the Greeks causing us harm and pain. We're just looking for price and range and width. So here's a bearish view out in time. So you have all these tools and vehicles to try and pick areas where you want to put spreads on. In my career, which is a long time, I can't even tell you how many butterfly strategies I created. I know it's well over 500. And if you ask me how many did I hit at the target, quite a few. And let me tell you have a lot of fun when that happens. It's like a very rewarding feeling. But how many did I hit that were in range? Countless. It's just a wonderful, wonderful strategy. It's wonderful because you're not playing with a lot of the Greeks, which is the volatility, which is theta decay. You know what your risk is. What's my risk here? 20 cents times 10. 10 by 20 on. I'm risking $200. I know what I can risk. I can't lose more than that. That's the importance of butterflies. Risk reward is substantial. Is it difficult probability-wise? Yeah, in many factions you could say yes. But let's face it, if you're as good as you are with understanding the market, understanding how to read charts, you're going to pick areas where you think the stock's going to be in and fall in a range. I have a lot of students that have come to me over the past 6 months, and they said, I like this stock at this price. And I show him the butterfly at that price and what he could do with it. He says, wow, I pay that, and if it goes down there in that time frame, I could make that. That's exactly true. Well, I got to do a lot of them. I could afford to do a lot of them. It's cheap. Yes, it is cheap. So you just saw opportunities in real slides. Those were real legitimate slides and trades where you could create the butterfly. It's risk averse. Obviously, that's the price paid. Easy to manage. You sit there and you more or less, what do you have to manage? You just every night say to yourself, oh, I hope the stock can get to my middle price. That's your management. Okay? There's not a whole bunch you do. Why? Because time has to pass. Why time has to pass? Because that's when that price is going to start to change. What you bought it for, and if you sold it for those crazy prices, I hope no one would ever do that. And it doesn't change to become meaningful until you get to the last, when you do one that's May 16th, it's not going to really show an effect of moving to your range price-wise until the last week. And then it really starts to happen when? Always the last 2 days of the expiry. That's when the butterfly's wings open up or they've been crushed because they're nowhere near your range. And then you have the ability to exit for profitability. You know, like I showed you in the first one, you always want to have more than one. Why? I don't want to be left with the dilemma. Now I'm at a price during the week, which is profitable. Do I hold on to it to go for the middle, or do I get out? Well, if you have two of them, or multiples of, you take your profits and you whittle it down to where you have a couple or one runner, and you let it go, man, and see if you can get to that middle. And then it's the Grand Prix of racing. You just cross the finish line in style. Great strategy, risk averse. It's a way to be bullish. It's a way to be bearish in stocks and indexes. It's one of my favorite strategies, and it's one of my bullet points in my outline when I'm teaching and explaining to students in our mentoring course how and why the prices change. It's all because of time. It's all because of the Greeks. It's all because of price of the stock. And that's what happens with the butterfly. So you basically, when you get into it that far out in time, May 16th, on March 14th, you're in that little cocoon. And then it gets to the week of the expiry of 16th, and all of a sudden, now you're at close to your middle price. Man, oh man, that's going to be an exciting time because that butterfly is waking up. So this is what we do in our mentoring classes. This is what we talk about. This is just one of the many strategies implemented for bullish, bearish, and neutral. What's neutral? Neutral, buying it for it to close here. And, ways to think about selling a butterfly is a whole nother way of trading it. But you're just basically selling and collecting a premium where your risk is the difference of the strikes to the premium that you sold at. So the question is, do you want to do that? Well, I certainly wouldn't want to do it out in time for 20 cents or 30 cents. That's absolutely insane. Would you do it in the last couple days? Yeah. If I was trading a butterfly in the last couple days and Thursday it was trading at 250 for a 5-point butterfly, and it's right at the middle, and maybe there's 2 days and there's news coming out the next day on Friday where the market's pretty volatile, you might want to sell it to try and make that 250 if it goes outside the range. But you're doing one-to-one risk in that case. Sell for 250 to lose 250. But it's something that you think about. I love them from the buy side. I love them from the buy side because there's opportunity to create directional trading, and you're not risking a lot of money. You're not putting up a lot of capital. So it's just a great vehicle, great tool for that. Okay? There's my contact information. Stan talked about us in the very beginning. Stan is more or less the person that I'm always bouncing ideas off. He's been there for 20 years. I've only been there for 2.5. And then the grand poobah, of course, is Larry, who is one of my favorite people in the options world. He's got more knowledge in his baby finger than most of the option trading people. McMillan's top, next slide I could show you, is there's enormous amount of subscriptions that are available. Because of our special for the webinar here, you get 1 month subscriptions to the daily strategist, the option strategist, and the daily volume alerts. These are areas on the website, and these are subscriptions on the website. They're giving Larry and his great team of individuals that are programming and building Larry's models and creating a huge database on a daily basis of updating spreads. there's spreads in all of these 3 subscriptions, which are wonderful spreads that obviously they're putting on, and you could put on. And you could take the ones that have the higher probability, which is the way they're put into the subscription. And there's a lot of great vehicles there for making money. And for that price, it's very tough to beat. When you do the mentoring, you can see all of the mentoring information on the website. The mentoring is something I do individually, one-on-one. The sessions are normally supposed to be 45 minutes, but as you can tell, I talk fast, talk a lot, so they normally go an hour. But the good side, the flip side that's good about that is I record every session, depending upon how many you're taking. And the sessions are normally in groups of 12 or 24. And we record them. Why? Because a lot of my students, several of which are in listening to this webinar, they're probably laughing because a lot of them take the recording and spend several hours listening to them over and over again. And one of my favorite stories is, I'm sure Dr. Weisman is in the attendance here. He would always listen to the recordings on Saturdays, the end of the week of the recording, and I'd get a text or a phone call, and he'd be screaming and yelling, SPO, SPO. SPO was my acronym on the floor for matching up trades with other traders or brokers. SPO, I got it, I got it. That was very gratifying. So, mentoring is fun and exciting for me because I'm teaching people. And as my goal with all my students, if I can't make money for you in what you've learned and implementing the strategies that you will then take that knowledge and make money with it, if I can't get you to that point, that means I failed. And I hate failing, just so you know. I'm a very competitive individual. Even at my age, I have extraordinary energy. I'm 70. I've been at this for, like I said, since I was 23. I have a young family of a 13-year-old, a 12-year-old, and a six-year-old. So I have to have a lot of energy for them. And I have dogs. We have pets. So I love the business. I love what I do with McMillan Analysis, and I love the program. And I'd be very thrilled if anybody wanted to learn more. Trust me, there is so much more to learn. And you're just basically picking my brain dry of all those years of experience. And the fun part about the last 2 years is I found new strategies that came out of the 0 days to expiration. And those are iron condors and iron time flies and iron flies. And they're fabulous strategies. And they're fabulous to learn them and understand them. And you see the volume that people trade in these 0 days to expiration. And when you get a knowledge base of how I explain what's going on in there, it's really very worthwhile. You may take a whole different stand if you're trading them right now than you would after you learn what's going on with the Greeks in that environment. So Stan is still here with us, I'm sure. So I've come to a conclusion of my webinar. I hope it was very beneficial for information and knowledge. And the fun part about it is I do my recordings for mentoring. This is recorded, so you can take your time and listen to segments of it a little at a time to make sure that I didn't leave you standing at the starting gate. I wanted to get everything in there, and I covered all 24 slides in 33 minutes, in an hour and 3 minutes.
Very good, Mark. Mark, thank you so much. Hey, do you have a couple of minutes for some questions?
Sure.
There's really two questions. Several people asked, but it boils down to two real questions, I think. Well, and there's a couple of others that maybe you'll get back to, offline. But the main questions were having to do with what do you do if the stock continues to run outside of the neutral profit range? Do you adjust, or do you close, or just?
Well, the problem you have is you've built a range, and you built a range with a very minimal dollar amount of investment. Now, if you start making changes, okay, and there's a lot of time left, it's a big mistake because stocks go up, go down. It could leave the range, come back into the range. the key factor is that you have put on a play for a minimal cost, risk reward wise. If you want to put on another strategy, to take advantage of, well, it's moving outside of our range. If you want to roll the butterfly up or down, you can, but I don't think that that's worthwhile. What you want to do is you want to get it to the shortest time frame of that expiry, which is the last, that week of, the last 2 or 3 days of. And at that point, you're going to see if that fly has a chance because it's in your range. If you have a lot of time left, like the May 16th, and it moves, I've had butterflies on that it's moved 30, 40 points out of range, come back down before the expiry of that butterfly. If you're in the one that we did in the very beginning, which was the neutral one for the 1 week, and we put it on and the market got crushed or ran like it did the last couple of days here, yeah, you probably would be a loser of that small amount of money. You don't want to be making adjustments in the fly. Can you do adjustments? Yeah. That's something I probably would have to spend time with, understanding what it is you want to accomplish. Because you've got to remember something. The market gives you what to do. You have to have the acumen to know, once it gives you what to do with it. You don't tell the market what to do. It tells you what to do. And you want to have all the tools that you possibly can to capitalize on that. And that's really what I always am teaching in the mentoring is, every day is a new day. Every day is a new opportunity. I don't believe if I coulda, woulda. That doesn't exist. One of my main rules is that you have to understand how to take a loss. Because if you don't understand how to take a loss, you'll never be a successful trader. You have to understand. Every now and then you look in the mirror and say, man, that wasn't a good trade that I made. Man, I made a mistake. And you move on. Throw water on your face, get out there and do it again. Those people that do that, that's where you let your losers close out quickly and let your profits run. People that do that and are successful at that, and they check their ego at the door, there's nothing wrong with being confident and cocky, but as long as you have control of that and your ego, and you understand that you have to have humility, you will succeed. You may miss on 2 or 3 of these for 30 cents, 40 cents, but then you hit the one that goes to 5. Guess what? You're looking pretty sweet. So I like to let them sit. Let them stay in that cocoon until they come out of it.
Gotcha. Okay. Well, thank you for that. Just one comment here. You talked about theta, and during this presentation, you didn't talk a lot about the other Greeks, but during the mentoring program, will you talk about the other Greeks and how they relate to the butterfly?
So, well, the Greeks, as I kept saying in the presentation, the Greeks, as far as the theta, the vol assumptions, are pretty neutral. Let's face it. When you have the Greeks, you have the implied vol, which trickles down to the delta, which is the relationship of the move of the option to the price of the stock of the strike that you're in. Then you have the gamma, which is basically the move of the delta with the relationship to the move of the stock to the strike you're in. And then you have your vega, which is basically your dollar value assumption of an increase or decrease of 1 percentage point change of that implied volatility. And then you get down to the point, we don't count rho, it's interest rates. Interest rates are pretty static most of the time. Right now, around 4.5%. What we look at next is that we have our theta. Theta is to me, is always the elephant in the room. Theta is the difference between winning and losing, and making a lot of money, losing a lot of money if you don't understand it. And the theta in the butterfly has been neutralized by the volatilities being basically equal to each other. But in the mentoring, we talk about all of that. Why? Every spread has a different profile of the Greeks. And the reason why I chose the butterfly, I wanted to get something that was simple, that didn't involve the Greeks in that explanation, because, as novices or even professional traders, even people that I'm teaching now that run their own, I had a Fidelity fund manager take the course. I have bankers. I have hedge fund traders. I have people managing their own portfolios. You know, they want to understand how to do what needs to be done to manage it. That means manage their theta, manage their deltas, manage their risk profile. And when you get to the program, and we cover everything, we cover all the different spreads. I mean, we go from top to bottom, time spreads, verticals, talk about the boxes, the anomalies of when the boxes are more than the strike differentials. We talk about jelly rolls, was one of my discussions with a student today. Most people don't know what a jelly roll is other than a donut. Then you've got every form of vertical. You have back spreads, ratio spreads. You have straddles, strangles. The list goes on. And when you look at all of them, some of them are very sensitive to the Greeks. And you need to know what they are to understand how to be able to harness and deal with them. And that's what we do. That's the most important part, I think, of what goes on in the mentoring, is that when you get in, if you don't have a knowledge of the Greeks, when you leave, you will definitely have a knowledge of the Greeks, because that's the unknown. When you look at the 6 elements of pricing, you know, you pull up what that is, and you're going to see the big abstract is going to be implied volatility. Well, you see it on the screen, but what everybody doesn't realize is the bid of the call and the bid of the put is that implied volatility. Okay? When that price changes, that vol is changing. Okay? And as time goes on, you can see when you look at a vol skew of all the different expiries of all the weeklies, the quarterlies, the leaps, and you look at all the vol skew, and you'll see how vol is changing when you go from week to week to week to week to month to month to month, and then you'll see little tweaks in there. I guarantee those tweaks where it's going up is probably an earnings week. So you have a lot of things relative to vol, which is key. Vol is the key to option trading. So the trades that I gave you today were very vol agnostic, where it's not going to hurt us. A lot of all of the other trades, they're very risky. And if you don't understand and embrace what those Greeks are and how to see what they move relative to each other. I mean, I do a crush trade, which is a time spread in the high flyers. And most people think, wow, that's the crush trade. It's because the vol spikes and it's going to come down? I says, yeah, it's because of that. But everybody thinks it's because of the week of the earnings. The volatility for that week is going from 50 to 190. And when it comes down on the morning of the expiry, because the news is out, it comes crashing down, they think that's the crush. Man, that has nothing to do with the crush. It has to do with the long side of that time spread if you're long it. Why? It has 8, 7, 9 days of life left. Probability, more premium, more time.
Terrific. Okay, well, thank you very much, Mark. Great presentation. And we look forward to doing another one.
I have one question I'm just glancing at that I want to, it says, an individual, do you hedge with butterflies? When I did butterflies in the biotech fund with my best friend, when I did that, when you're in biotech, it's basically a totally burn cash instrument. You're looking to get into a biotech, what you hope discovers the next cure for cancer, and you hope that you're massively long it, and you're hoping for a takeover by GlaxoSmithKline or Lilly or Johnson & Johnson. So you're playing for the upside. Well, the only way to protect to the downside, because we're always massively long, is either to have downside positions in verticals and indexes which have a high beta to those stocks, the stocks have a high beta in those indexes. And believe it or not, I used to create lower put butterflies in the indexes of those stocks individually and in the XBI and in the different indexes, sometimes the SPY, where I would put on huge butterflies down lower where the butterflies were 50 to 100 points wide in the indexes, or in the individual XBI, when the XBI was traded in the 90s, I would put on 30 or 40 point butterflies lower where I paid very little, but I put on, 500 by 1,000 by 500. Because if the market cracked, my biotech stocks were going to get annihilated, and I had to have some downside. So yes, you can hedge with butterflies.
Okay, I guess we're done for this evening. Thanks again, and we'll be back soon. All right,
Thank
take
you.
care.
Thank you, Stan.
All right.